I'm very happy that I'm in this strategy right now because if anything, volatility seems higher than ever for all
Hmm.
kinds of reasons, some economic, some geopolitical, some more political. But for whatever reason, there are a lot of macro reasons that make me happy that in my micro investing, I'm doing it in a fairly predictable and not dependent on capital gains, so I can sleep a little better at night.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When stocks are as richly valued as they are today, investors, especially older ones looking to live off the wealth they've already built, start to prefer safer assets that provide income. Today's guest, Stephen Bavaria, author of The Income Factory, has appeared several times on this channel sharing his approach to income investing, which he claims can deliver similar long-term returns as stocks, but within a greater margin of safety. Stephen returns today to give us an update on how his approach is working here in 2025, a year of elevated volatility and bond yield so far. Stephen, thanks so much for joining us today.
Thank you, Adam. It's a pleasure to be here again.
Thanks. Well, it's a pleasure to have you back on, my friend. All right, Stephen. So, the main point of this discussion is to give folks an update as to how the Income Factory framework is performing so far in a year that's been quite volatile. Um, I guess let's get straight to that, but maybe in your answer, if you can just start off with giving as concise a summary of your Income Factory framework for the people that might not have seen your previous interviews on this channel.
Sure, and I'll try to keep it as concise as I can. I think most rational investors over the long term would like to earn what's a typical equity return of, say, 9 or 10%, over the long term. And if you do it with traditional equity, Nobel Prizes have been won demonstrating that the easiest and best way to do that is to buy an index of, the S&P 500 or something equivalent, hold it through thick and thin, and generally you will achieve over that long-term average, say plus or minus 9%. I don't claim the income factory is any better than that at all, but it's an alternative way to try to do the same thing. If you think that math is math, and that you earn a total return it's the dividend plus the capital gain or loss on your portfolio, and those two together added up in a period is the total return. That means you could earn a 9% return with 9% yield and 0% growth, or 9% growth and 0% yield, or anything in between, 5 and 4, whatever. And so it's a mathematical certainty that you could achieve that with yield, and not much capital gain at all. And that's the approach I take. Now, what's not a mathematical certainty is that the particular assets I choose that I think will get me my 8, 9, 10% yield will actually do it. I mean, there's always risk, that you won't earn that yield or the capital gain if you're going the other route. But the income factory is an approach where we try to use mostly high yield stocks and a lot of credit investments that earn 9, 10% or more sometimes in interest, and those are more predictable asset classes because you're not depending so much on capital gains. So that's the theory, and that's what we're trying to achieve. I try to achieve it personally, mostly with high yield credit investments, using closed end funds as the vehicle to hold them, because closed end funds are often a better, more effective way to hold illiquid or less liquid assets, and high yield bonds, senior loans, CLOs, which we've discussed, collateralized loan obligations, and different sort of complex asset classes or less liquid are safer to hold in a closed end vehicle. So that's why I use those, sometimes ETFs as well. But so our approach is, it's about 75% credit and maybe 25% utilities and other high yielding equities in my own personal portfolio and in the model portfolios we use. And recently, just to say how we're doing, we've been earning yields in the 10 to 11% range. I'm a little more aggressive in my personal portfolio, so I'm up to about 12% yields. And in terms of total return, we've actually been matching pretty well. That's not our goal so much, but we have been matching the S&P 500 in that we've taken some capital losses, on paper losses, but they're offset by the yield we're getting. And if you don't sell, my approach is to not worry much about short-term capital gains and losses and just build up the income, reinvest it. When you reinvest, if your prices are down and you're reinvesting the same income you were earning 6 months or a year earlier when prices were up, you're actually reinvesting at lower bargain prices and higher yields. So you're building your income faster during periods when when the market is actually down. So anyway, we've been earning the same total return for the last year or so as the S&P 500, but they're only paying a yield of about 1.5% or a little lower right now, whereas we're collecting yields and reinvesting them of 9, 10, 11%. So that's where we are, and I'm very happy that I'm in this strategy right now, because if anything, volatility seems higher than ever for all kinds of reasons, some economic, some geopolitical, some more political. But for whatever reason, there are a lot of macro reasons that make me happy that in my micro investing, I'm doing it in a fairly predictable and not dependent on capital gains, so I can sleep a little better at night. And I'm told by many of my readers and members of my investment group that they're sleeping better at night too. I hope that's the case.
Okay, well, great summary. I'm glad to hear that things are performing well. Congratulations that the income factor is continuing to do well in this type of environment that we're in. I just want to underscore and dig into a couple of things you mentioned here. So first off, your goal is steady returns, right? So you're basically trying to build a portfolio that delivers S&P-like returns over time, but really without all the volatility, right? The S&P delivers those average returns, but one year it might be up 20%, the next year it might be down 8, et cetera. So on any given 12-month comparison, it fluctuates wildly, where the income factor is much more steady eddy, right? Hey, we gave you 10% last year, we gave you maybe 9% this year, maybe 11% the year after that. It's much more steady, correct?
That's the plan. And to get even one step nerdier about this, my underlying philosophy is pretty much based on what they've been teaching in finance courses in grad schools, although I never took any, for years, going back to the 1930s, that the market prices of any asset theoretically reflect the income that it generates over its life.
Right.
And that at any given time, the discounted present value of the future income of an asset is what it's, in a perfectly efficient market, is what its market price would be. So what I'm really trying to do is manage for that income flow. And my theory is that since most of us are saving and investing for, to create our own pensions, if you will, 10, 20, 30, 40 years from now, depending on our ages, if we focus on building that cash income, then market values will pretty much take care of themselves. And if I'm growing my income at 9 or 10% a year, which means I'll be doubling the income under the rule of 72, every 8, 9, 10 years, depending on what rate I'm getting, I'm averaging, then it's going to be, who knows what, 16 or 32 times what I'm starting with, and I'm adding to it anyway over time. So the market price will take care of itself, but I'm not really worried about that, because my income itself will be so much greater years from now that, that's why I can say somewhat confidently that short-term market swings I can pretty much ignore.
Great. And I want to dig into that just a little bit more. But let me walk my way there. But I am correct where the factory basically delivers much more steady and dependable returns on
Mhm.
average than an equity index like the S&P, right?
That's exactly it will over time, and it definitely will if what you're defining as returns is the income, the cash income that it's steadily growing, then it
Yes.
definitely will. Yes.
Sorry. Yes.
Mhm.
Those income yields. Yeah. So for example, we take 2025, market is really it's little change since the start of the year. But if you went on that ride as an equity investor, you were panicked, in April, right?
Mhm.
Whereas if you were in the income factory, well, you didn't really see that much of a difference at all to your income streams any given month, January through June so far, correct?
That's right. It's interesting. The market value of my personal portfolio, which is modeled pretty much. I have a core model. I have other models for our readers, but I also publish for total transparency what my personal portfolio is, and the proportions I have in each fund and everything. And it's equal right now in market value to almost exactly what it was at the beginning of the year. But it's been up and down, just like an S&P 500. It's kind of matched it to some extent. But my monthly income is actually up from what it started at, which is what I make. In other words, I'm reinvesting, and that income's growing, even though the paper value of the portfolio creating the income's worth less right now. But
Right,
not
because
we're
and that's what you were saying
doing.
earlier, which is periods where the market value of the actual
Yeah,
underlying instrument goes down, your dollar cost averaging in with those
that's
monthly
right.
income payments at lower and lower amounts.
And
Okay.
it's the portfolio's doing its job the way a factory that Ford Motor Company builds spends millions on, but nobody at Ford except the green eye shade accountants worry about what they could sell the factory for, a week or a month or a year later. They only focus on how much it's producing, how many
How many
cars.
cars come out? Right.
Yeah, that's why I call it the income factory. It's kind of a cute name that I
No,
trademarked. Yeah.
it's a great name, and I'm working my way towards where I think you're going here, which is there's the yield that you're getting every month,
Mhm.
right?
Right.
And the annual yield of about 10 to 12% somewhere.
Yeah.
And then there's the underlying market value of the instruments. And I want to get to that in a moment because I think that's where people maybe have the greatest hitch about getting into the income factory. So I want to address that head on in just a second, but I want to clarify one or two other things closely first. Um, so you mentioned that closed-end funds are a common instrument or vehicle in which you use to invest in these income-producing assets. And I just want to note for folks, and have you correct me if this is wrong, but uh, what that allows you to do is two things. You can look at um, the instrument and say, okay, this is a good time to invest in this type of product, right? CLOs, whatever, right? So you can kind of look at the market environment for that asset class and say this is a
Yeah.
good time to add them to the portfolio given their value. And you can use a closed-end fund to do that. But then because it's a closed-end fund, um, it can trade at times above or below its net asset value. So you can just look at how that particular fund is trading relative to its net asset value, and you can say, well, I'm not going to buy it today because it seems a little bit rich, but I'll wait until it gets to a discount of its net asset value, and then I'll buy in. So you have the ability to buy an attractive asset class at the right time in that given fund, given the potential discount the fund is on, right? So there's two ways to kind of get addition, or two ways to go for yield there, correct?
That's right. Once you've decided that asset class X, corporate loans or high yield bonds or whatever it is an asset class you want to be in for all the, economic reasons and everything, then you go into the closed end fund market and you may find 10 or 20 funds that all are involved in that asset class, and you narrow it down. You You want to pick ones that are well managed, that have been around a long time, that have a good long-term record. But then, as you say, some of them may be selling at discounts to the asset value of the fund, which means if you took all the assets in the fund and added them up and divided by the number of shares outstanding, their actual net asset value per share would be higher than what their market value currently is, because it's an illiquid market. Closed-end funds are a kind of funky market where it's not always high volume. So one big player moves in and buys a fund, and it drives a premium up for a day or so, or a week, or a month even, or a bunch of people get scared out of an asset class for reasons I don't regard as rational, let's say, and it'll drop to a discount. So you can time your trades in and out to kind of increase the value you're getting, increase your downside risk a little. All that, yeah, you can do all that to kind of help yourself, at the margins. And you can trade back and forth. You might have two senior loan funds that are equally well managed and with good records, and you might trade back and forth over time between them. As one goes to a premium, you sell it and you buy the other at a discount, and vice versa.
Great. So I just wanted to let folks understand that there's kind of, there's additional ways to gain value here. And one of this is through the arbitrage of what the funds are trading at on any given day. All right. So, I really like the analogy of the factory. And as you say, if you're Ford, you don't really care about the market value of the factory because you're not planning on selling it tomorrow, right?
Mm-hmm.
You care about how many cars it's making, right? And your portfolio is very similar, where you don't really care on any given day what its market value is. If you add up all the securities that you have in it, you care much more about what's it giving me this month in terms of a return, right?
Mm-hmm.
So I think
Real
one worry
estate.
that people have, let me just
Mhm.
mention this, you can answer.
Sure.
So I think one worry that people have is okay, well, if this instrument is giving me yield over time, but the absolute underlying value of the instrument is declining over time, that makes me nervous, and maybe I'm not gonna, maybe the income payments over time won't add up to if this thing goes to zero, add up to the market value that I've lost or whatnot. So how do you talk to that concern, and how often does that happen?
Actually, that's a good point, and it's a tricky one that I've written a number of articles on Seeking Alpha for regular Seeking Alpha viewers, readers, and for my own investor group. Total return, you start with that. The total return of a fund is its dividend plus capital gains and losses. And there are funds out there, because there are a lot of income investors, retirees, other people who really love income, who buy closed-end funds. And some closed-end funds are more careful, I'll say, than others. Some will stretch to give greater income than they actually earn as funds, and sometimes funds can't even can hardly avoid doing that either, because the way closed-end funds work, they're required by regulation to pay out, I believe it's 90% of their taxable income. And if you're a fund that owns loans, for example, or other assets that, pay off at maturity contractually at 100%. You have a loan, it pays you 10% interest, and then you collect your 100 cents on the dollar when at the end of 5 years or 10 years or whatever. There are some defaults, in the credit markets.
Mm-hmm.
It's like there are bankruptcies in the stock market. And sometimes a fund will be collecting interest from various assets, and putting that into their income because they have to. It's their taxable income, the cash they collect, and they have to pay out 90% of that as dividends to their shareholders. If some of those they don't end up collecting 100%, and later
Right.
in the life they only, they go bankrupt or they default, and they only get back 60 or 70%, which is normal with a loan. You're secured, you get back 70%, but you take a loss of 30. You've already paid out your dividend, assuming you're going to get 100 on that.
Mm-hmm.
So there's a certain amount of natural declining annuity in certain asset classes. And some funds are better than others, or better able to kind of reserve for that. See, they're not, if it were a bank like JP Morgan, they could reserve and take it off their taxes for potential loan losses. But closed-end funds pretty much have to pay out what they collect, and they can't reserve for potential losses that way. So yes, you have some funds that pay out more. And what happens is this erodes their price, their net asset value, or even their market price. If the market sees this happening, it'll bring the market price down, and then net asset value will be going down. So you might have a fund that is paying you 12%, but then when you look at its total return over time, it's only 9 or 10%. That means that its dividends are high, but it has a capital loss. So its total return is the difference between the two. So you could have a 14% dividend. The fund might erode 3% a year on its price. And so its real total return is only 11%. It's still a good asset. It still can be a good investment, because 11% is a pretty attractive return. But
Right.
if collecting 14%, you've got to be alert to the fact that, hey, I'm collecting more than this fund's actually earning. So you better, at least, even if say you're retired and you're collecting your income and spending it, you don't want to collect more than, well, in that case, 11%. If you took out the full 14% of the dividend, and the price of this fund was eroding by the 3% difference, and you kept the whole 14%, pretty soon you'd have a dwindling annuity, and you don't want that. But if you reinvest at least the 3 or 4, or even more than the difference between the distribution and the actual total return after the price erosion, then you'll be fine. I mean, I've got articles explaining that. Some people say, I won't touch any fund that pays out more than it actually earns. But if they avoid some of those funds, even after taking the difference, you're still got 11, 12, 13% total returns, and they're good investments.
Okay, and this is what I just want to make really clear for listeners. I'll make sure I'm understanding this right. So, should we think of the income factory as I put capital in, that capital is going to the market value of that capital is I should expect it to erode at some rate, but I'm looking to try to get a return, a yield off of that capital, or income off of that capital, that is going to grow hopefully substantially higher than the net asset value erosion. And so, to use your example, maybe the company is paying out 13%, but when I take into account the erosion of the actual asset value, given the income I've gotten offsetting that, I'm getting about a 10% or 11% return, right? Still a really good return, still a great investment. It's a reason to do this, but I've just got to be aware that what I'm really looking for is income to dramatically offset the capital erosion. And if I heard you correctly, if I were to completely just, if I were looking to live off the income of this thing, right, and it's paying me X income and I'm spending all of that, well, then you have this eroding annuity that's not going to be around forever. So two things you want to consider. One is, obviously, if you don't need to live off it, at least not yet, just keep reinvesting the income that you're getting, and that will dramatically grow your net asset value over time, because yes, it's eroding at a certain rate, but you're reinvesting much more income than that regularly to buy more assets. And so net your assets are growing. So to your earlier point, as time goes on, your thing is kicking off more and more absolute income because it's continuing to grow. Now, if you need some income, what you want to do is you want to make sure that you're at least you're at least keeping enough income or reinvesting enough income to make up for that erosion of net asset value. So over time, you can kind of at least keep your net asset value steady while you're living off of some income. So there's lots of ways to play this. You can just reinvest everything and grow to your heart's content. You can operate it at sort of steady state, have some income, keep your net asset flat. Or maybe if you're 90 You know, you just start living off the income and you don't really care because you're going to outlive the erosion of the underlying capital. Did I capture that correctly?
You did, but I would like to emphasize, I mean, that my intention is not to is not to have my capital or any of my members of my income factory, my inside the income factory group, let their capital diminish unless they chose to. You're right. Even most retirees, though, if you retire at 60 or 65, as many people do, or 70 even, a lot of people live into their 90s these days, and certainly we all hope to. And so you've got to be investing with a bit of a long-term flavor, even when you're retired. But as you say, once you're maybe 90, and if your kids are all doing well and you aren't worried about leaving a lot for them, yeah, then you could actually turn your capital into a bit of an annuity and really go out with a bang your final years. But just to look at my core model, my main model, for example, the last time I reviewed it about a week ago, the average yield, this is about almost 40 different funds, and people can pick and choose which ones they want. Not everybody buys the whole model, but its average yield is 11.2%. Now, if you go back over 5 years, the average total return is 15%. So the typical fund in it has had a total return greater than the current yield. Now, there are some years where there's a little bit of a gap because a lot of funds try to manage their yields and keep on paying. Even if they have a few months where they're not fully earning it, they're looking ahead and thinking, well, we will be earning it again in 6 months, so they keep their dividend flat. You have to keep an eye on that, and that's part of my job to do that. But my goal is not to pick funds that have this erosion, but there are some that will. And we also have some very high yielding funds that buy collateralized loan obligations, which are a pretty complex investment, but their institutions invested in them for years quite successfully. And now there's some closed-end funds like ECC and OXLC and Carlyle Credit, CCIF. But there are these CLO funds that buy the equity of these. And for whatever reasons, and some of the reasons I mentioned earlier, that they're forced to pay out. If they have very high payments in certain years, they're forced to pay out big dividends that they don't expect to actually earn over the long run. Some of these funds have been paying out close to 20% in yields. I wouldn't want anybody to buy those funds and keep the entire 20%. But if they wanted to keep half of it, they'd probably be fine and reinvest the other half. So there will be funds we pick that we know are going to have NAV erosion, but they're still going to have such high dividends that the total return will be quite adequate. But they'll be in the minority, and they're special situations.
Okay.
Like
I just really wanted to dig into this one because I know people get hung up
yeah.
on the like, yeah, I'm buying this asset that might go down, and why would I want to do that? And obviously, it makes a lot of sense to do that if the income stream is much higher than the net asset value erosion rate.
It's total return. The key is you got to look at total return, which captures both that erosion and the dividend. And if the total return is adequate, then it's a good investment, but you may not want to keep it all. You may want to make sure you're reinvesting a big portion of it.
Well, that's the second point, and it differentiates your approach from, say, owning a treasury, right? Because
Yeah,
I can get the income from the treasury, I can spend 100% of that, and I know I'm going to get 100% of my principal back when the loan
that's true.
matures. So this one,
Yep.
you have to, even though it's an income factory, you do want to make sure that you are reinvesting at least enough of the income that you're receiving to keep things
Mhm.
sustainable.
The lower the yield on your asset, usually the safer the principal is, and usually the the lack of any erosion risk you have. So if you're willing to buy assets that only earn 4 or 5, 6, even 7%, then there are plenty of assets that are going to not erode in principal. It's when you get up into the teens and higher that you have this potential trade-off, but it's worth investigating because to get yields that high, knowing you're going to keep most or all of it, it's worth it, if you pick the right ones. And that's our job then, to try to execute this strategy with appropriate funds, with assets that are solid, that we can depend on the income.
Yeah, and again, what's really attractive about your approach is it's self-reinforcing. The more that you allow to get reinvested, the bigger the pile that your average yield
That's
is
right.
getting applied to every year. So let's just say your lifetime, performance is 10% a year. That 10% is growing every year because the pile that 10% is being applied to is growing because of the reinvestments.
Yeah, if you start out with and you're earning 10% a year, even if you add nothing except the reinvestment, which is at 10%, you're going to double and redouble every 7 years, basically.
Right. Right. So if you're 50 and you start an income
Oh,
factory, by the time you're 70, you're going to be pretty darn happy. And this is,
oh my
again, one
God.
way to,
Yeah,
to fight inflation, right? Yeah.
even in 20 years, it's every 7 years, it would go from 2 to 4 to 8, and then to 16. In 28 years, it'd be 16 times.
Yeah. So, a guy like me who's in his, I was going to say early, but getting close to mid 50s, start this now. By the time I'm 80, I'm going to be really glad I did.
You're a kid, Adam.
You're very kind. All right. Well, look, what as you look at all the different assets that you consider for the income factory, and it might be helpful just to give folks a quick run through of a list of the different type of assets you have, because I've even forgotten a lot of them.
Sure.
There's the CLOs you talked about. There's high yield debt. There's business development corporation. There's all sorts of things. You know the list better than I. But what's performing best right now in this market environment?
Well, when you say performing, for me, performance means I'm collecting the money and I'm not too worried about default rates. Before performing doesn't mean it's shooting up in market price necessarily, but
Yeah.
I
Maybe a
feel,
better way to ask the question is if somebody were considering building an income factory right now, given the current market dynamics, are there any assets you would say,
yeah,
given their valuations right now, you'd say, I'd look at adding these first?
yeah. First of all, since we don't know which way interest rates are going to go,
Right.
I mean, if we end up having a hard landing or whatever kind of landing we're going to have, or a recession, or if tariffs end up restricting economic activity of various kinds and we end up with a recession, rates could end up, what would they'd have to take rates down. But if we have inflation, et cetera, rates could go up. So I'd first of all say I'd want a mixture of funds, some of which are floating rate, like senior loans. Corporate senior loans have a great record, and there are some. I look at, some I like Nuveen floating rate, JFR, FS Credit Opportunity, FSCO, that are earning, they're paying yields now of 11%, some of them, that but as rates come down, these are floating rate loans. You don't have any duration risk, but your rates can come down, and it's normal that they will. But I hold a lot of senior loan funds, but then I also own high yield bond funds, some of the PIMCO funds, the like KIO, that's KKR, Income Opportunities Fund. I like funds that are run by people that have been doing this a long
Yeah.
time too, really good credit shops. Because I'm not worried if rates go up or down, and the income they pay, the rate they pay changes over time. I'm quite prepared to have part of my portfolio earn 8 or 9%, and other times earn 10, 11, 12%. But I want people that really have been doing this a long time. Like, go ahead.
Yeah. Let me just add on to that, Stephen.
Yeah.
So, folks, if you're new to this concept, right, and you think, oh, income factory sounds really cool, I might want to do that myself. First off, go buy Stephen's book, The Income Factory, and you can see it right there. You can get that on Amazon and
Shameless,
everywhere.
shameless self-promotion, we call this. Yes.
Yeah. But folks, you can buy that anywhere that books are sold. So develop an understanding of kind of the mechanics of it. But, like anything, it takes a while to become a master at it. And so I would highly recommend looking over the shoulder of someone who's very seasoned in doing this. And so therefore, at the end of this, Stephen, I'll let you tell everybody where they can go follow you and your work over there at Seeking Alpha. But obviously consider, subscribing to a service like Stephen's to watch an expert do this, and then, over time begin to copy them and develop your confidence in doing this. But then, as Stephen is saying, when you're actually deciding what to invest in, a big thing that Stephen does is to say, hey, I'm not just going to try to analyze all these individual loans myself. I'd much rather buy a fund where somebody who is an expert and has been doing this for decades and has all sorts of advantages that I don't have, relationships, economies of scale, decades of experience, whatever, can manage this for me. And that's why you like these funds, because you target funds that are run by these
Mhm.
experts with a proven track record, correct?
That's right. And I'll name like I said, I like senior loans for a lot of reasons. I like high yield bonds, which are the same cohort of companies, high yield companies. These are non-investment grade companies. They were often called junk bonds, but we know from experience these so-called junk bonds, they only they only default. Lately default rates have been like 1-2%. Even in a recession, they might go up to 5 or 6%. During the worst recession of our lifetimes, 18 years ago or so, they went up to about 10%. But you get back 50, 60 cents on the dollar. Typically on the loans, you get more. On bonds, you might get 40, 50%. So a 10% default rate is still only 5% losses or 4% losses, which in a recession that's not even going to take away a year's income. So it'll reduce your income that year, but it won't even touch your principal. So you're going to be so much better off, say even in a recession, than if you owned a stock portfolio. So this is very relatively predictable compared to equity. So I like I own some senior loan funds, high yield bond funds like KIO, there are a bunch of PIMCO funds, PDI, uh, there PAXS, and then like Barings, which is the Mass Mutual, which has been doing private credit of this sort for generations. I really like. They have a fund, BGH, Barings Global Short Duration High Yield. So there are a lot of funds, and then there are a few funds like Ares. There's some of these outfits like Ares, which is a great credit shop. It has the Dynamic Credit Allocation Fund, ARDC, which goes both ways. They have a mandate to buy loans or bonds. So I like people like that who can be, looking at the different markets and who know more than I do about which way interest rates are going to go and how to play it.
All right. And by the way, thank you for being so generous and naming these tickers. People love to have companies to go out and research. So thank you for doing that. Stephen he's the drug dealer. He's given out some of the supply for free here. So if you like what you see, then go over obviously and check out his Seeking Alpha site.
You get no warranties here either. You get what you pay for. But these
Yep.
are the
And
things I own. And then you mentioned earlier business development companies, BDCs. They're like mini banks. And that's another asset class uh, that I buy because they do a lot of what's called private credit. It's generally secured. It's often to companies that aren't really well known. Many of these outfits, like Bain Capital Specialty Finance, BCSF, or Barings, Mass Mutual also has a BDC called BBDC, Barings BDC. Apollo has one called Midcap Financial, MFIC, and KKR has one, FSK. So you've got a lot of big names that are doing these business development companies that are essentially doing private capital, private lending, often to smaller companies that they meet because they know the private equity market really well. So you've got PE firms that do private equity that then work with, sometimes it's the same firm or a part of the same firm, or other firms they know well, like the ones I just mentioned, that they're lending to companies where they know the owners really well. And so if there's ever any kind of a problem and you need to work out the deal, they're working closely with the PE firm that owns it. So I'm a big believer in BDCs again, as an all-weather sort of asset class. I don't go in and out of loans or in and out of high yield bonds. I may switch from one fund to another depending on discounts and premiums, but to me, these are all weather funds, that all weather asset classes that you'd want to be in, all the time, and you'd be making more from in some periods than in others. So you got BDCs, high yield bonds, senior loans, and then there are like real estate funds. There are utility funds like Reeves Utility Income. A lot of people own. It's been around for years. UTG, and it was down a few years ago when the utilities all got hit, and now it's bounced back with a lot of other utility funds. So and there are infrastructure funds too that do master limited partnerships, that carry oil and gas underground all through our country, between here and Canada and other places. You have funds like Neuberger Berman has an energy fund, NML, that's pretty good. Cohen and Steers Infrastructure, UTF, is another good one. There's a lot of funds that just generate income from these different asset classes.
All right. Again, thank you for being so generous. And again,
Sure.
folks, none of this is personal financial advice. You got to do your own homework here. I would highly recommend talking to your own, personal financial
Yeah.
advisor about this. All right. So one point, and then I want to get back the question for you about the private credit funds. But in general, and you mentioned high yield bonds specifically earlier, for people who are not that experienced in investing in bonds that aren't super safe, like treasuries, right? They
Mhm.
get worried about the credit risk, right? And they
Yep.
hear things like high yield bonds, and they know they're called junk bonds, right? And they understandably may feel like, well, gosh, this is kind of high risk, and if we get into a recession or whatnot, maybe this bond might default, right? So you've done a very good job in our previous conversations talking about how one of the things that really appeals to you about the income factory is it is largely credit based. So credit is a contract, right? And it basically says, I, the business, will pay you X over this period of time, right? And so your risk as the investor in that is the existential risk of the company, right? Or the enterprise risk, I think you call it, which is, the company could go out of business, right?
Yep.
But that's the only risk that you bear, besides inflation risk, which
Yeah.
everybody bears. If you were to buy the equity of that same company, you would also have the existential or enterprise risk, right? Company goes bankrupt, your stock's not going to be worth anything. But then you have all sorts of other risk there, right? You have, well, did the company have a bad quarter and the street soured on its earnings outlook for the company, and all of a sudden the market value of the company gets cut in half? Does the general stock market go through a bear market, and that's going to bring prices down, right? There are all these things that can, all these other risks that can impact the price of your asset that you don't have in the credit world. So first and foremost, you're kind of de-risking by just looking at credit alone. Also, if there is a really negative event for the company, and let's say it does go bankrupt, well, the equity holders, they're last in line. Chances are they're going to get nothing. Depending upon where you are in the credit stack, you might get a fair amount of your money back, right? And you've even said that, even in recessions, even these quote unquote high yield junk bonds, their default risk really isn't that large. I don't want to say it's immaterial, but you've generally said it's not that material here. And the last point I'll make, and I'll let you chime in, is, you say people will look at high yield credit for a company and say, I'm just not comfortable with that. But then they'll go buy the stock of that same like a lot of the popularly traded stocks today are high yield debt issuers. And so for some reason, because most people are more comfortable, familiar, whatever, with stock markets, or they'll buy into a fund that then invests in the equity of these companies that issue the high yield debt. They actually will turn down the safer option for the riskier often, maybe totally unintentionally, but it's just what their behavior is. So my overall point here is that your approach tends to be a much more risk managed one versus the equity approach, correct?
Yeah, I mean, you said it all perfectly. I summarize it in two ways. Yeah, one, that's right. Understanding that the credit risk you are taking, as you say, it's the existential risk, and the stock risk is the entrepreneurial risk. The risk when you're buying a stock, you're betting that obviously the company will remain alive and pay its debts, which is the same risk you're taking as a credit investor. But if you buy the stock, you're also betting that in addition to staying alive, it'll thrive and grow its earnings, its dividends, all of which it may not do. But you've got a CEO of that company and a senior management team who are paid a lot of money to keep that company alive and muddle through no matter what. So no matter what happens to our country, to our economy, even if the stock market tanks, you've got most of corporate America where there's going to be a management team working like mad to keep it alive and pay its debts because they've got so much invested in it themselves that they're and in their salaries and bonuses and everything else. So they've got to keep their company going. So yeah, I call it betting on horses to, if you could go to the track and just bet on horses to make it around the track and survive the race, as opposed to betting on the horses to win or place or show, it'd be a real easy bet to just bet on the field to get around. And that's what you're doing when you're betting on credit. But the other thing you said is true. The same people who say, oh my gosh, this junk bonds and all this, it's so scary. I'll never buy that. You look in their portfolios and they own mid cap funds and small cap funds that are filled with these same companies whose debt they say they wouldn't buy, but they own the stock. As you say, if the company goes bust, uh, you know, they lose, obviously they lose the stock, but if the stock goes to hell, people above them buying the debt will be fine. So yeah, that's a big point in the favor of credit investing generally.
Right, right. Well, I love that analogy of the racetrack, and I think it's super apt for how for your strategy. Listening to you, it really hit me that like a lot of people will say, look, you want to be invested in the stock market long term because you are putting basically the greed of corporate America, you're having that work in your favor, right? These people want to make money. They want to get their stock options higher and all that stuff. So you're hitching your wagon to their greed, right? What I think you've done is you've gone a step below in Maslow's hierarchy of needs. Like at the core foundation, you're putting their sense of self-preservation. You're
That's
hitching your
right.
wagon to their sense of self-preservation. At some point in time, when things get bad enough, you're going to ditch your greed part and just do everything you can just to keep the company alive, right? Because you still want to have a job, you still want to have a potential future. So
That's
you've got their like
right.
the
And
the
I've
lowest part of their base stem and their cerebral cortex is
oh,
working 24/7 for your interests.
absolutely. I wrote an earlier book called Too Greedy for Adam Smith about my experiences in corporate America, where I was very close to the compensation function at a major bank many, many years ago. And I saw how CEOs sit on each other's boards and set each other's pay, which is why you have Jamie Dimon, for example. I don't know who he does a great job, I'm sure, as CEO, and all these other CEOs, but they're making 30, 40, 50 million dollars with bonuses and stock options and even more than that, some of them, where if you went and actually advertised to hire CEOs of corporations, you'd have a line around the block of most of them of really
Hmm.
qualified people who'd be willing to do it for only maybe 2 or 3 million a year.
Hmm.
So what you say is true. Even the guys and women who make 30 and 40 million in a good year for their companies, if their companies had a really bad year and they didn't get any bonuses or anything that year, they'd still be, as you say, working like mad to keep the company alive, just to keep their $5 or $10 million base pay. If that's all they were going to get that one year or something, they'd still be busting their, what's to keep their companies alive. That's what I'm betting on. That in a really bad economy and everything, they'll still be working hard for me as a creditor, even if the shareholders are, not too happy.
Yeah, I think that's just brilliant. All right. Well, look, as we start to wrap up here, you mentioned private credit funds earlier. I know that you relatively recently wrote an article about this, Stephen, and there's some sort of seasonal opportunity that you found there, correct?
Yeah, yes, I did. It's actually for two particular funds, and they're actually terrific funds. As I mentioned earlier, Mass Mutual Life Insurance they've been in what used to be called the private placement market. When I was a journalist 35 years ago, I wrote about the private placement market and met some of the people up there. The private placement market, which is where insurance companies and pension funds would buy private debt that never went through a bank or anything. That's now morphed into a larger market called the private credit market, which a lot more investors are learning about and people are getting involved in. And they have two funds that they've had around for years. One it was called originally Mass Mutual. Now it's Barings because they used the trade name Barings that they bought some years ago. But it's MPV, which is Barings Participation Investors, and MCI, which is Barings Corporate Investors. But they're twins. They're siblings that buy the same stuff, the same boards and everything on them. And they have a funny dividend policy, I think, because they've been around so long. They've gotten into the habit of waiting until they have their annual meeting in May before they distribute their first quarter so-called dividend, which then gets paid out like the beginning of June. So they end up paying 4 quarterly dividends, both companies the same, from the beginning of June through the beginning of January. So, and actually the ex-dividend dates for those 4 quarterly dividends are like the end of May, and then for the first one, and then the end of December for the next one. So if you own the stock from the end of each fund from the end of May and then sell it the first week of January, if you own the funds for 7 months, basically, you get all the entire year's dividends because the 4 quarterly dividends are fit into this 7 month period. I mean, there's nothing wrong or about this or unethical or immoral. I mean, the company's a wonderful company, but they just got into the habit of paying their dividends that way. And so you could actually sell the company, in the first week of January and then buy it again at the very end of May, just before their ex-dividend date, and buy another company. Another fund that pays monthly dividends and collect 4 or 5 January, February, March, April, May. You can collect 5 months of dividends if you pick the right one. And in fact, you could pick another Mass Mutual company, a fund called that's BGH that I mentioned earlier. Great fund. It pays monthly dividends, and their ex-dividend dates are such that you can actually fit them into the January through May period that you had sold the others. So you can actually take the 8% per annum return yield on MPV or MCI and only own the fund for 7 months, and then buy BGH or any other funds that are monthly payers and collect. When it comes down to it, you're getting 17/12 of annual dividends within a year by doing this, what I call this dividend holiday trade. Now, for all I know, maybe the company will we'll figure this out and say, hey, maybe we should pay every month and not on this weird quarterly basis. But as long as they're doing it right now, this, it makes sense. I wrote an article about it. Some of my members chimed in, and together we figured out what we could do here. And, as of now, you could actually get 17/12 of an annual, dividend by buying this fund, owning it for 7 months, and then buying a replacement fund in between. So that's a
That's
little benefit here by being, once in a while we get cute and figure something like this out. So
That's very cool. Well, who
there
wouldn't
you go.
love 17 months worth of performance in only 12 months? And it's great that your community kind of helped you sort of sleuth out the final approach that
Yeah,
you use there.
yeah.
So,
Now I
folks,
will mention, I mean, there's a risk to something like this because something could, the fund could become a lot more expensive. I mean, it hasn't in the past. There hasn't been any kind of arbitrage to correct this advantage. But if the fund were to jump in value over those 5 months and you went to buy it back and it was going to cost you that much more, it would obviate the advantage you had. But then whatever you bought, you could just decide to keep it because there are plenty of, you might have bought a replacement fund for those 5 months, and if you're happy with it, you just keep it and you don't buy back into these. So I don't see much of a downside risk to this at the moment.
all right. Well, folks, if you think this is interesting, Stephen has been kind enough to share that article with Thoughtful Money's premium Substack subscribers as part of this week's Macro Pass service. So if you're a premium subscriber, you should hopefully already have that in your inbox by the time this video comes out. And Stephen, thanks you so much again for making that available. But that's super interesting. All right, last question for you before we wrap things up, Stephen. Before we hopped on the camera, you mentioned something else about dynamic credit funds and why those are good or worth considering during periods where interest rates are uncertain the way that they are right now. So what do you want to tell us about those funds?
Well, the main one I mentioned was Ares Dynamic Credit Allocation Fund. Yeah, let's see, KKR also has a fund, KIO, which I think also has the flexibility if its managers choose to go back and forth between senior loans, which are floating rate, and high yield bonds, which are fixed rate. Of the two, well, they're both good funds. Ares has a better longer term performance record, I think, but it doesn't pay as high a yield. KIO pays a 12% yield right now. So they're both worth looking at. I think the PIMCO funds too. PIMCO has a great reputation for, following the markets and figuring out, how to make money in all markets as well. But Ares in particular, because it has dynamic credit right in its name,
Hmm.
seems to be promoting itself as flexible in this area. I'm just saying because yields can go in both directions, and especially right now, we don't know what's going to be happening over the next 6 months or 12 months. So having both kinds of funds, senior loan funds, high yield bond funds, BDCs, which own a lot of floating rate, well secured debt, but are managed by very sophisticated folks. Um, they're all worth having right now, just to diversify yourself so don't have all your eggs in either a rising interest rate or a falling interest rate basket.
All right. Well, Stephen, wonderful again. Thank you for sharing all of these tickers with this audience to go out and research on their own. For folks that have really enjoyed this hour discussion and maybe especially some of the ones that might not have known about the Income Factory beforehand, if they would like to learn more about it, follow you and your work, where should they go between now and your next appearance on this channel?
I don't have the link right in front of me, but it's real easy. First of all, if they Google the Income Factory or my name, Stephen Bavaria, they will get links to my Seeking Alpha uh, uh, homepage. which will tell them all about Inside the Income Factory and what I do. They can also go to Seeking Alpha, to the general Seeking Alpha page, which is so easy to find. If you just go on search for Seeking Alpha, you'll find it. And then within that, you could put my name or Income Factory, and you'd get brought to my site. It's easy to find if you Google me or the name Income Factory.
All right, and you know what, Stephen, too, folks, I'll put up a redirect at Thoughtful Money. So if you just want to go to thoughtfulmoney.com/income factory, it'll take you straight to that link there on Seeking Alpha that Stephen just mentioned.
Great.
All right. Well, Stephen, look, it's always so wonderful doing this. Folks, if you've appreciated this, would like Stephen to come back again in a quarter to give us an update on this framework and share what assets he thinks look good at that point in time, please encourage him to do that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you are thinking of taking up this approach in your life, like I said, definitely go to Stephen's work, learn all about it. But I highly recommend that most people just don't go, forth and start grabbing assets willy-nilly. I'd highly recommend that you talk to a good financial advisor to determine how much of your portfolio should be in an income factory strategy like this, and maybe get their help in assembling it together. If you've got a good one who can do that for you, great. But if you don't, feel free to consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To schedule one of those consultations, just fill out the short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. The firms will be in touch with you right away. Just a free service they offer. There's no commitment to work with these firms. They just want to be helpful. All right, Stephen, again, thanks so much. I will give you the last word here as folks look ahead to what is likely to continue to be a volatile and mercurial 2025, filled with all sorts of surprises and news bombs like we seem to be getting multiple times a day. What would your parting counsel to today's regular investor be?
Well, I would just say good luck, first of all, but also spend time, any ideas you've gotten from me or anyone else, just make sure you think them through, do the research and understand it yourself. In other words, if it makes sense to you, then by all means, do it. It's very hard. We all have to work. We worry a lot about what's going on in the world generally. I call, worrying about the macro, but we have to live in the micro. Mm-hmm. and combine the two. So best of luck and with doing that in your own investment world. But I appreciate you considering what I do and appreciate Adam having me on again. Thanks.
Well, you're very welcome, Stephen. And I very much appreciate that your approach is one that is very risk managed. It gives people who are nervous, especially in the equity markets today, another alternative to consider that can perhaps give them similar types of returns that the market has enjoyed, historically, but do so with less risk and allow them to sleep more at night. So for folks that find this interesting, I hope they find their way to your work. But anyway, Stephen, thank you so much, my friend. Look forward to having you back on in another quarter or so. And best of luck in the interim.
Thank you, Adam. Same to you.
Thank you. And everybody else, thanks so much for watching.
China is buying gold like crazy. The people in China are buying gold. They love gold, and the central bank is also buying gold on a consistent monthly basis, basically. China is the largest gold producer already, and they consistently buy more gold. They use this, of course, as a way also to attack America, because gold is the antidote to the American fiat dollar money system, and they plan to build gold vaults in many other countries. Gold is clearly in a secular bull market. The only caveat would be if we see gold now really accelerating dramatically over the next few months and maybe 1-2 years, doubling in price immediately and running to maybe 8,000-9,000 in the next 1 or 2 years, then it would probably have the characteristics of more of a bubble, and we would have to be careful. But if it's just pushing higher like it's been doing now the last 14 months, I think it's very healthy, it's very sustainable.
China is both the largest gold producer and a heavy buyer, with its people and central bank consistently accumulating gold as a hedge against the US dollar. China is building vaults abroad to back trade in yuan with gold, challenging the dollar system. China's central bank has increased its holdings of gold for 10 months in a row, ending in August 2025. Their gold reserves rose to about 74.02 million fine troy ounces. Gold is in a long-term bull market, and while a sudden surge to $8,000 to $9,000 within a year or two could signal a bubble, the current steady rise looks healthy and sustainable, pointing to much higher prices ahead. Florian Grimmies, a precious metals and cryptocurrency analyst and investor, highlights that central banks in China, Russia, and India are buying gold instead of Bitcoin, while the US is pushing into digital assets to maintain dominance, raising concerns about surveillance and sustainability. A World Gold Council survey shows 76% of central banks expect to raise gold reserves in the next 5 years. China has boosted its gold reserves for 10 straight months, joining Russia and India in favoring gold over Bitcoin, which remains too volatile and unrecognized as a reserve asset. Rising stagflation risks, low growth plus high inflation, are driving demand for hedges like gold and real estate. Analysts warn that while gold's inflation-adjusted price is at record highs, steady demand could lift it toward $3,700 to $4,000 per ounce by 2026. Tracking wealth in gold or Bitcoin, rather than just dollars, shows how purchasing power continues to decline. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
The Chinese, the Russian, and the Indian central bank are buying gold and not Bitcoin. The Americans desperately need something new to continue basically running their hegemony, and apparently they decided it's going to be the digital asset space. It makes sense to a certain level. At the same time, a digital dollar as a stable coin, is this really much better? No, it's not. I mean, I'm very much worried about the whole surveillance kind of thing. I'm not sure if Trump himself really understands the whole thing. I think he has a lot of advisors who are telling him what to do and what to say, but if he really understood it, I don't know. It probably is the last chance that America can do, because they are not having enough gold.
You know, it's interesting. I read recently that Trump's assets, his corporate and family assets, have shifted from real estate predominantly to now crypto and Bitcoin predominantly.
Of course, it's amazing. I mean, who would have thought that, right? A year ago. To a certain extent, I would say yes. I mean, I think first of all, the Trump family just wants to make as much money as possible.
Okay.
So that's, I think, the major intent here. And I think it's very questionable what's going on here. Very questionable. But at the same time, of course, I mean, the administration before was also extremely questionable because they were completely against it.
Yes.
Didn't allow any invention here and progress. So I at least that's what I appreciate now with Trump. But I think it's a turbo casino capitalism kind of style here. And Trump makes sure that his family makes a fortune here. And anything else, I don't know. Is it really better? I mean, yes, they create more demand for US treasuries if people buy more Tether, and then this is getting converted into the crypto market. Yeah, okay, but is this really sustainable? I don't know. I mean, the whole thing is more and more questionable in my opinion. Yeah, exactly. That's what's going on. On the one hand, massive expansion of the money supply, and not only in America, all over the world. If you look at these numbers for the European Union, if you look on Japan, on China, everyone is basically printing money. And on the other hand, the consumers are losing the confidence in these currencies, in these fiat currencies, because they see that they have less and less purchasing power. And so people are trying to escape into hard assets. And that's why, at the end of the day, real estate is still holding up rather well. Okay, there is regional differences, but overall, it's holding up well. And in many areas, actually, real estate is still getting more expensive. Your stock market overall, even though there's lots of questionable things happening in the economy, and you see that basically a stagflationary kind of scenario, the stock market is higher because people buy these stocks as a hard asset, so to speak, moving their money out of the fiat world. And gold, precious metals, mining stocks are moving higher, and crypto as well. And even your rare stamps and your old timers are getting more expensive because the fiat money is losing purchasing power and people losing confidence. I mean, you can see it in many countries. The society is becoming rather unstable. Some of them are actually close to a civil war. These are all the consequences out of it, and this is just continuing. You know? I don't see a turnaround. It basically says that on the one hand, central banks, politicians, increasing the fiat money supply, basically printing money out of thin air, and on the other hand, consumers and participants in these financial systems are losing the confidence because they can see that the purchasing power of their fiat currencies is diminishing by the day in the end of the day. And that's basically happening at the same time. And what it means is your assets or your investments can go up on a nominal basis, while in real terms they haven't moved at all. But people only look at the value of their assets in nominal terms, meaning in dollar. I mean, how many people are actually looking or calculating their net worth in Bitcoin and in gold ounces? It gives you a totally different picture over a 5 or 10 year time frame than just looking at it in terms of how many US dollars am I in total, or how many euros or Canadian dollars, right? So I'm doing this as a little homework every 4 months, updating a little Excel sheet, tracking my net worth, and you can see how challenging it can be actually to keep up in terms of Bitcoin and gold with your total net worth. You know, you might have more euros or dollars, but not more Bitcoin and gold.
Florian recalls, in 2022, when the Fed hiked rates, Bitcoin crashed, and gold dipped but held much stronger as a safe haven anchor. Since its triple low 3 years ago, gold has risen over 130%, supported by 4 key drivers: expanding global money supply, the bond bear market pushing institutions toward gold, massive central bank buying since sanctions on Russia, and China's relentless gold accumulation for both citizens and reserves. China, already the largest producer, is building vaults abroad to back trade in yuan with gold, challenging the dollar system. This shift is unwinding decades of paper gold price manipulation, as physical demand now drives the market. Beijing is also making gold imports/exports easier. It's seeking feedback on streamlining licensing processes, longer valid licenses, more customs offices authorized, to smooth gold trade. China's consistent accumulation supports the idea that demand from major sovereigns is backing gold's secular bull market. The fact that China is pushing through regulatory/reform steps for gold import licensing underscores a long-term strategy rather than a short-term bet. Central banks globally continue with strong, steady gold purchases in the face of geopolitical risk, inflation, and concerns about US dollar reserve dependency.
First of all, in that 2022, when the Fed started hiking interest rates and everything came under pressure, Bitcoin went down to $15,800 from $69,000, and gold came down to $16,15 from 2070-ish. And had a triple low, more or less 3 years ago. But gold held up much better during that time than everything else. So I remember being very happy having a large chunk of my portfolio in physical gold, because it basically stabilized and was rather a safe haven anchor in that time when everything else was plummeting. So since then, yeah, gold is up 130% since that triple low 3 years ago. And you asked for the driver. So in my presentation yesterday in the morning here at the conference, I presented my take on it. I think there's 4 big, very important macro drivers for gold. The first one, I mentioned it before already, M2, money supply, the liquidity basically in the system, constantly being expanded over the last few years, and especially now again in the last few months. And not only in America, but also in the Eurozone, in Japan, in China, wherever you go basically. If you would look at South Africa or Brazil, you would basically see similar numbers. So liquidity expansion. Second big driver is the bear market in bonds, especially in the long-term bonds. So the long end of the bond market, I think the Fed has lost control over it already. We have still a rather persistent inflation. And if you're an institutional investor and you have to seek safe, conservative, long-term bonds, and now you are in a bear market in bonds, it's very challenging. So I assume more and more institutional money will go into gold because it's the only other asset that they can buy. So that's the second driver. The third driver is central bank buying. We haven't seen that in like decades, that strong demand from central banks. Of course, it increased dramatically since Russia invaded Ukraine, when the whole world realized, like, whoa, the Americans, NATO, the Europeans just can confiscate our assets whenever, however they want. So now lots of emerging market central banks and nations are trying to diversify themselves out of the dollar, out of the euro, de-dollarization. Central banks are buying gold. They don't chase gold, but they also don't really care about $100, $200. So that's exactly what we've seen over the last 14 months. Whenever there was a consolidation in gold, you didn't really have a big pullback because very quickly physical demand showed up in the market again. And the last one, which is also very important, probably the most important besides the central banks, is China. China is buying gold like crazy. The people in China are buying gold. They love gold. And the central bank is also buying gold on a consistent monthly basis, basically. China is the largest gold producer already, and they consistently buy more gold. They use this, of course, as a way also to attack America, because gold is the antidote to the American fiat dollar money system. And they plan to build gold vaults in many other countries.
Yeah.
So if they do their trade business with Saudi Arabia and they buy the oil from the Saudis, they will give them the renminbi, and the Saudis can take these renminbis, go in their own country, go to the vault, here's the paper renminbi, show me the gold. And I mean, this is what the Chinese are working on, to inject confidence into their yuan kind of system, building an alternative system to the US dollar system. And that's not going away. Those four drivers that I just mentioned, I mean, they're going to be around for the next 1, 2, 3 years at least. It could maybe take a decade or even longer until this fully plays out. And I think during that time, gold will be strongly supported. There will be strong physical demand. And out of the consequences also out of those four drivers is that you are seeing now the unwinding of that 50 plus decade Anglo-Saxon paper gold Ponzi scheme kind of system, right?
Yeah.
So we know that in the past five decades, the price making or the price finding for gold has been dominated by trading 200 paper ounces of gold for 1 real ounce of gold. That's how mainly the price finding has basically happened. And this is being unwinded now. And this can take a long time. And again, I just mentioned it before, gold is super strong, no real pullbacks here, no dips, people chasing, running behind the train. It just pushes higher, and whenever there is a dip, immediately big hands showing up with physical demand. And I think it's super bullish. Gold is clearly in a secular bull market. I think the price targets that you and I were talking about 5 years, around $9,000, if you remember.
Yeah.
I think that's still the case. We probably have to revise them, and it's probably gonna go even higher. The only caveat would be if we see gold now really accelerating dramatically over the next few months and maybe 1, 2 years, doubling in price immediately and running to maybe 8,000, 9,000 in the next 1 or 2 years, then it would probably have the characteristics of more of a bubble, and we would have to be careful. But if it's just pushing higher like it's been doing now the last 14 months, I think it's very healthy, it's very sustainable, and we're going to see much higher prices. And this can last for at least a few more years, at least.
Could China's gold-backed trade strategy accelerate the decline of dollar dominance in global finance? How might central bank gold buying continue to influence prices compared to private or retail demand? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, thank you for being with us, and wait for the next updates.
Confidence in the dollar is slipping, and gold and silver, with its long-term 5,000-year track record. Speaking of 5,000, that's the number that we're getting out of Goldman Sachs if just 1% of the money that's in treasuries pulls out of treasuries. Bald Guy Money did an interesting one, and he said if 20% pulled out, he was getting $9,000 gold. And it wouldn't surprise me. And then they revalue it. The higher the price of gold goes, only benefits this country on many levels, not only through the devaluing of the dollar, but also, of course, the ability to, if Judy Shelton is right, peg gold to the back end of the treasury. What happens if gold keeps going? Put gold at $5,000 an ounce, like Goldman says, and divide by 70, and you got a lot. You got $350. Or put it at $5,000 and divide by 90, where we are right now, $55. Silver's going much higher.
Confidence in the dollar is fading, pushing investors toward gold and silver with their 5,000-year track record. Goldman Sachs says if just 1% of Treasury money shifts, gold could hit $5,000, and some estimates go as high as $9,000. If gold reaches $5,000, as some forecast, silver could climb anywhere from $55 to $350, pointing to much higher prices ahead. Andy Schectman, the president and CEO of Miles Franklin Precious Metals, points out that, similar to central banks, people might profit by diversifying into gold and silver as currencies decline. According to Goldman Sachs, if even 1% of U.S. Treasury funds move, gold might hit between $4,500 and $5,000 next year. In the meantime, the concerning job data indicate that full-time employment is declining, part-time and multiple job holders are increasing, and about 1 million jobs have probably been revised downward. Future rate reduction will cause margins to further shrink, making smaller regional banks particularly susceptible. As we play snippets from the video, please hit the bell to receive quick alerts whenever we post a new video, like this video, and subscribe to our channel. I appreciate your support. Have fun watching the video.
Pick used to say all currencies, fiat, are inherently meant to die. In essence, it could go to infinity. Now, I'm not saying that's going to happen, obviously, but, I just think that people could benefit from diversifying more heavily into gold and silver, like the central banks have. Goldman Sachs sees the scope for prices to move well beyond 4,000 as their baseline forecast for next year. And even beyond the 4,500 tail risk scenario. This is, again, no public participation, but if 1% puts their money in of privately owned U.S. treasuries, they're saying 5,000 an ounce. So I don't know. But I just want to hammer it home. If Trump lowers yields by 2 or 3% real yields, it'll be negative. Even by their numbers, big money will not stand for that. That's why they are front-running this. The world's largest players, the central banks, the global lenders, the corporations, the global lenders being the commercial banks, the ultra-wealthy, they've all been quietly repositioning. But once it becomes obvious that the public will realize that fiat money is eroding, is it too late at that point? I don't know. I'll leave that up to everyone else. A couple last things here. The jobs report. The consensus was that between 40 and 100,000 jobs would largely greenlight a 25 basis point rate cut. But we would need a massive, massive outlier for the Fed to cut by 50 basis points. Well, we got that outlier. The BLS reported that in August we only added 22,000 jobs, not the 79,000 jobs that were expected. But more importantly, June was revised from 27,000 to negative 13,000. It's the first negative print since 2020. They keep revising these jobs numbers. Remember what happened with July and August, those numbers. To the ugliest part, in my opinion, of the jobs report was the number of full-time jobs. They fell by 357,000 jobs. It's the second consecutive month of full-time job losses, while part-time jobs surged by 597,000. So you lost 357,000 full-time benefit-paying jobs, and you added 597,000 part-time. Kind of seems like people are working 2 or 3 jobs to make ends meet. It gets worse. The number of native-born workers fell by 561,000 to 132.474 million. This was the biggest drop in quite some time. At the same time, foreign-born workers increased by 50,000. The number of multiple job holders soared by over 443,000 to 8.785 million. This was the biggest monthly increase since COVID, and another indication of how stupid the jobs report in the Bureau of Labor Statistics. We should just pull the L out of it, and it should be called the BS. They continue to do this stuff. Now, next week, I think, is it next week? I think it is. They are supposed to revise job growth figures from early 2024 through early 2025. Forecasters have thought that job growth would be slower than previously thought. Now you're getting analysts saying revisions anywhere from 475,000 to 1 million jobs will be revised out. Originally the number was 1.76 million. They're talking about revising 1 million out of the 1.76. I think, let's see, I got maybe 2 or 3 more things left to say. I found it interesting that Trump says that the United States has lost India and Russia to China. And he said, may they have a long and prosperous future together. That's what he came out and said that. And maybe that's because both India and China confirmed to boost their ties to reduce the effect of Trump tariffs at the Shanghai Cooperation meeting. We're seeing insured deposits shrink out of the banks. In particular, the regional banks and the small banks, and a lot of money is finding competition with digital banks and stable coins. And wait till you see what happens with all these stable coins, with fintechs and stable coins offering higher yields and lower fees and instant transfers because they don't have brick and mortar, and they don't have ATMs and all this stuff. We're not out of the woods yet with the banks, and the more we start moving towards this digital system of stable coins, you're going to massively erode the stickiness of bank deposits, and which has been the foundation of bank stability. If the Fed cuts rates, banks are going to earn less from lending, but still need to pay competitive deposit rates, which squeezes the margins and makes the weaker regional banks more vulnerable.
Andy Schectman highlights that with significant institutional and individual orders as well as historic ETF inflows, there is a massive stockpiling of silver. Saudi Arabia and other major players may still demand supply even though SLV raises questions about manipulation. BlackRock has even cautioned that a short squeeze brought on by silver shortages might drive prices skyrocketing. Silver should already be far higher given the current price of gold. At historical ratios, it might be between $90 and $100 per ounce, and in the worst cases, it could even be $500 or more. Now let's redirect our attention towards the interview.
You're seeing the numbers in all of vaults except the LBMA, which is going the opposite direction. But yeah, you're seeing massive, we're seeing really large orders even in the retail side. We're just not seeing the huge volume. But 7-figure orders are no longer the exception at all. But yeah, you look at the COMEX numbers, there's a massive amount of hoarding. You look at the amount going into the world's ETFs, it's huge. So I hate that part of it, SLV, which is really a tool for manipulation because of the naked shorting. I would much rather see the money go into physical and drain. When you look at like Saudi Arabia, who took this huge position in SLV, the one saving grace is the position is large enough to where they can demand delivery. And it's like when the Texas Teachers Union, which was being run by Kyle Bass years ago, put $1 billion into gold. He took possession out of GLD. So, but just simply at face value, yes, that is true. The ETFs and many of the Western exchanges are seeing record inflow, not all of it leaving, and the numbers, the eligible numbers, are going much higher. But there is some leaving, certainly. But you're right. It is very obvious that there is a huge amount of hoarding. This will promote, very possibly, that short squeeze that everyone's been waiting for, because there's just not enough in the way of those size good delivery bars in the West to really to protect. In fact, even BlackRock wrote in the prospectus of SLV that be careful if you're short, because there could come a time when there isn't enough silver to cover those positions, and it's a big threat. Now you're talking a squeeze and the price goes up parabolically and bankrupts people. So ultimately, that would be where I think this is hedging or heading to. The first step would be taking huge positions and hoarding it, not selling it at prices anywhere near where we are now, because, just taking where we are right now, if you look at gold right now at 3640, call it, and if we divide 3640 even by 70, which is way higher, that's $52 right now. It should be massively higher than it is right now. And if you did it by the average, even call it 40 to 1, where it's been about 45 to 1 for the last 100 years on average, you're looking at $91 an ounce silver. Is that out of line? No. And at 45 to 1, it's still 7 times higher than it's coming out of the ground at. So, 91 times 7, in theory, $700 an ounce silver. I'm not saying that's going to happen, but I mean, is it the craziest thing to think of? If you take 34 or 3640 divided by 7, which is the geologic ratio, it's actually 520. So let's get a little bit more realistic. But $520 would represent the current geologic ratio. But what happens if gold keeps going? Put gold at $5,000 an ounce, like Goldman says, and divide by 70, and you got a lot. You got $350. Or put it at $5,000 and divide by 90, where we are right now, $55. Silver's going much higher, for sure.
A critical period for both gold and silver seems to be approaching, driven by mounting supply restrictions, central bank buildup, and waning dollar confidence. The outlook indicates that both metals may see significantly higher prices in the future because of the big positions taken by institutional and sovereign purchasers, as well as the possibility of a silver short squeeze. How soon might gold and silver hit these anticipated levels if central banks keep moving away from the dollar? Would a silver short squeeze primarily help long-term holders of actual silver, or could it cause more widespread financial market instability? In the space provided for comments below, express your opinions about Andy's insight. Please think about sponsoring us and putting on notifications if you think this video is educational so you can see our most recent videos. See you in the video that follows. I appreciate you viewing.
In the next handful of months between now and the end of the year, silver is likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. To be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher price of gold. Well, right now, silver's 1.12%. Decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds. 100 to 200 would not surprise me.
Central bank and sovereign demand for silver is rising, supporting higher prices, while COMEX and LB delivery activity and ETF redemptions indicate big players are taking physical possession. Analysts view silver as undervalued versus gold and expect a breakout, targeting $60 to $70 by year-end, with potential $100 to $200 plus in a full monetary or credit stress scenario. Risks include unverified accumulation data and uncertain timing of delivery squeezes. Michael Oliver, CEO and founder of Momentum Structural Analysis, argues that measuring silver in dollar terms is almost meaningless. He sees silver potentially reaching $100 to $200 but takes it in stages, personally favoring silver miners over gold. Historically, silver has averaged around 2% of gold's price and even hit 3 to 3.5% in past bull markets, while today it sits at just 1.12%. With silver already up 42% this year versus gold's 37%, technical charts suggest an imminent breakout. Several well-known bullion commentators and dealers' voices like Andy, Bill Holter and Mike Maloney argue the market is now driven by huge physical demand, tightening supply and central bank sovereign buying, conditions that can push silver rapidly higher and make a $60 to $70 year-end print plausible. They point to record COMEX delivery interest, growing central bank interest in silver, and China's physical buying as the catalyst for an imminent breakout. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I think it's really relevant. Yeah, as I said, so many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years, and plot it. We have a graph we put in the latest report. 2%, meaning divided ounces silver into gold. Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Okay, still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, "Ooh boy, you break through that and I'm going to blow the cork off this thing." The spread is about to do that, I think. And when it does, I think in the next handful of months, between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals.
Michael Oliver warns that relying too much on fundamentals can mislead investors about timing, like the analysts in The Big Short who were early but not immediately proven right. In 2025, silver has risen 45% so far, hitting about $42 by mid-September. Rising industrial demand for EVs and solar panels, continuous supply shortages of about 800 million ounces since 2021, and growing central bank and investor accumulation through physical holdings and ETFs are the main drivers of its climb. Although supply is static and demand is dominated by China, silver's industrial role is expanding. Nevertheless, until prices compel attention, markets frequently overlook such truths. More significantly, silver has historically been used in conjunction with gold as money. Confidence will crumble as inflation reduces purchasing power and people lose faith in institutions, currencies, and central banks. This transition from optimism to anxiety could be brought on by a declining stock market. Major systemic changes, like the Federal Reserve's demise or income tax reform, are made possible under that setting. That unrest will help silver as an industrial metal and as currency. Let's shift our attention towards the interview.
Well, first off, I don't look at it that much, and I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. Mm-hmm. You could be right and not be right in terms of price reaction for 2 years, okay? You know, do you remember the movie The Big Short?
Yeah.
The guy, these 3 or 4 analysts around the country, different guys, didn't know each other, all came up with the same conclusion. There's going to be a mortgage crisis. There's no way around it. They pounded the table, okay? That was 2005, 2006. And it wasn't until late 2007 that the stock market finally topped. And it wasn't until 2008 finally that they said, I was right. So you get the point, fundamentals, okay. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. The annual production of silver is not increasing, it's plateaued, and demand is continually increasing. And by the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, which silver is essential. So anyway, that could become a factor where, let's say we cross 50 and CNBC needs an excuse to explain it, okay? And that's a good excuse. Oh, well, the industrial demand. Well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows, it has been. In fact, the U.S. has had silver as official money, too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt, where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. You suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. As I said, your grandfather, father, and you, house cost, loaf of bread price when I was a kid, it's 52 card pickup. And I think the stock market will be a big key in that. Why? Because right now, if you look at, let's say, the average guy who's got a retirement account, maybe it's through state government pension fund or whatever, if he looks at it nominally and it's been going up because if it reflects the S&P, then it's been going up. Okay. Not a lot, by the way, over the last year, but, single-digit percent still. It's the only thing he's got to smile at. Everything else in his life is questionable. Cost of things are going up, et cetera, et cetera. And when that goes down, then it's, oh, hell, what's good? All you need then is some layoffs, et cetera, et cetera. And suddenly the average guy, instead of a sense of expectation, is a sense of doubt. And that creates fear. And when you create fear, the tone of markets change. And that's when institutions can get overthrown, ousted, abolished. And so it wouldn't surprise me that in a year or two there's no Federal Reserve. If the economy gets bad enough, which I suspect it will, there may not be any income tax, simply because it doesn't function. They go to a sales tax, etc. All kinds of things can change in big ways. I think that's the kind of situation we're facing now.
As trust in fiat currencies and institutions declines, there is a chance for sharp movements. How much higher may silver's price realistically rise in the upcoming years if it even recovers to 2 to 3% of gold's value? Will a decline in trust in central banks hasten the adoption of silver as a monetary asset and an industrial necessity? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.